people who see it last are the ones who get hurt the most. Or maybe it's just the rich who see it last because they got the least to lose, because they're getting access to the money and they can make the money and they're buying equities and they think all is fine. Rich people can buy real estate on leverage and, all of this stuff.
Yeah.
But maybe they're the last to see it. Some see it, obviously, and others probably don't because they're all okay. And, their S&P portfolio has gone up and their gold looks fine. But they don't realize that they're probably getting net poorer. I mean, what's interesting is people have started to figure this out. They've started to figure out they're getting screwed.
Mm-hmm.
And the figuring out getting screwed drives you to look for answers. The traditional answer was gold. Hasn't done great. It's done okay. It's done its job. But the problem is the millennials can't generate wealth. If gold defends your wealth,
right? There's nothing to defend.
Nothing to defend.
Yeah.
So it becomes incredibly difficult to generate wealth. Bitcoin comes along. It changes the equation. It takes a long time for people to see it, but these things, this adoption takes a while.
Mm-hmm.
But people realize, okay, here is a construct, a technological construct that has ubiquitous global scarcity. And therefore, if we all perceive it to have value, then it shall be so.
Mm-hmm.
And so the migration begins. And I think of it as a migration to this parallel financial system that's being built in front of your eyes.
Mm-hmm.
The rise of DeFi was the other huge thing that happened. People haven't got their heads around what this means yet, but it is gigantic because basically people don't trust financial intermediaries any longer. Again, they want to blame somebody, so blame the banks. It wasn't the bank's fault. They just did the rational thing.
This is rational again too, right? If you can get a financial product of any kind with less counterparty risk that renders the same services, of course you're going to opt for that.
Of course.
Yeah.
Of course. And, that was the first thing. And I saw it very fast when I saw Bitcoin 2012. After Europe, I realized, okay, yeah, I get this totally. This is the future of everything, because I'd learned some shocking things in 2012. I went around the world to try and start the world's safest bank. And at the time, my idea was it should hold all deposits in treasury bonds of whichever country it was going to be.
Mm-hmm.
And they would be default risk free, pretty much so, and I tried to do it, but it's very hard to start a bank. And, I had some kind of pretty wealthy people, well-regarded people with me on that journey. It was just too hard. And then somebody showed me Bitcoin. And I thought, okay, this is interesting. The point being, what Bitcoin saw to me was that blockchain allowed the secure recorded ownership of everything, where it was traceable to who owns what.
Right.
And that was the problem that we had, is nobody knows who the hell owns what in an over-leveraged financial system.
So these are the DTCC and Euroclear. They're effectively the property layers of these financial systems, where instead of holding your own stock certificate or bond that would be presumably a bearer asset redeemable to the issuer, these systems hold all property
Correct.
rights and all stock certificates, all bonds,
Everything.
but they're not segregating them, mapping them to specific owners. So
well, they are until it's the DTCC themselves who are on the hook.
Gotcha. Okay.
Then all bets are off and it's each man for himself.
Got it. So this becomes another mechanism through which they're socializing losses from economic shocks.
They would do. It's never happened yet.
Okay.
But the fragility is there.
Right.
The other fragility was obviously the derivative market that nobody can figure out because there's 1 quadrillion of those outstanding. Right. So they start centralizing that as well.
Yeah.
Putting it into the CME and the other exchanges, ICE and stuff, to try and have some way of figuring out how the hell to stop it when it all goes wrong. But blockchain changed that because I saw it immediately and thought, well, every single security on earth is going on blockchain. Now, how decentralized it needs to be for that, open to debate. But it needs to be decentralized enough, and it needs to be on a blockchain that you can prove it. So this is where a lot of people start waking up and going, okay, we need a different way of doing things.
And so the big dynamic, sorry to interrupt, is this shift from a top-down
Centralized
model in the DTCC or Euroclear to something, a consensus that is more distributed and transparent for market actors?
Correct.
Okay.
So if you're the base layer of collateral, your equity or whatever it is that's been relent and reused and whatever it is, when it all goes wrong, the blockchain has full recorded every transaction. So it's not hidden somewhere. I mean, half the bloody swaps contracts were in bits of paper and drawers because derivatives was exploding in the market and nobody had the technology to onboard all of this stuff into a system that could record it.
Right.
You know, the same is true probably of insurance. If California has an earthquake, you know, who's double insured, who's single insured, who's claiming what? Nobody the hell knows. You know, nobody knows any of this stuff in the current system. It's got itself into a mess. So all of this becomes interesting. So the rise of crypto becomes an obvious thing, and it becomes a migration. So what I think you're going to see, and there's a lot more to come on this, what you're going to see is a ongoing gradual debasement and an ongoing gradual migration.
They
so
go
more
hand
people
in
opt
hand.
out.
Yeah.
And the people who see it last are the ones who get hurt the most. Or maybe it's just the rich who see it last because they got the least to lose, because they're getting access to the money and they can make the money and they're buying equities and they think all is fine. You know, rich people can buy real estate on leverage and, you know, all of this stuff.
Yeah.
But maybe they're the last to see it. Some see it, obviously, and others probably don't because they're all okay. And, you know, their S&P portfolio's gone up and their gold looks fine. But they don't realize that they're probably getting net poorer. I mean, one of the conversations I've had with corporate treasurers was that I presented some of the biggest corporate treasurers in America. I'm like, guys, what do you use your cash for? And they're like, well, we use it for share buybacks, M&A, and, you know, cash cushion, and we purchased real estate. I'm like, fantastic, great, okay. So your cash, you earn what? You know, maybe they're great treasurers. Maybe they get 3% on their cash. I'm like, great. Look at the price of assets. They're going up at about 15% a year, 20% a year in line with the balance sheet. So next year you can buy less of your shares back, or less of another company, or less of
real estate.
So this is why you need Bitcoin on your balance sheet, because it helps offset it, because it's got the two benefits of, it's got that kind of exponentiality, the call option on the future, the network effect, and it's got the other side of the equation, which is it offsets debasement. So it's got this kind of double feature. Gold doesn't have the double feature, it's got the one feature.
Right.
Bitcoin has the two features. So I'm like, this is what you need, and this is how it's going to work.